Hi, everyone. This is Jeff Praissman with Interactive Brokers. It's my pleasure to welcome back to our podcast NASDAQ's U.S. economist and senior director, Michael Normyle. Hey, Michael, how are you?
Doing well, thanks. Glad to be back.
I'm excited to have you for our monthly podcast, and particularly excited for this episode. We're going to do something a little bit different than we normally do. We generally talk about the economy or what's coming ahead and stuff, but this is going to be a fun one and a fun summer topic. So today, you had written an article a little while back on valuation of professional sports teams. So today we're going to take a nice dive into that. First thing I want to ask you is, given that professional sports teams, they've historically actually outperformed the S&P 500 by significant margins, why do you think more teams haven't pursued these public listings? And what barriers might be keeping the majority owners from taking this path?
Yeah, and to put some numbers on that outperformance, Morningstar researched sales over the last 20 years and found that the average sports team value has grown at least twice as fast as the S&P 500. And for the NBA, it was 3 times, and for MLS, it was 5 times. Now, in terms of why more teams aren't public, I think that's a good question. And it's pretty hard to say. I think it could be an overlooked and underappreciated option just because it's not been done by too many teams. Or, for example, with the NFL, it's not allowed by the rules. But I think maybe if we see more teams go through with it, then it could just become a more kind of popular option.
Yeah, and I can also see the fact that they are becoming so valuable that it might become at some point an only option, really.
Right.
There's only so many people that can buy these teams,
hmm
and if they continue to go up. But looking back at the data, it shows sports teams they've been, like you said, been a really good investment in recent years. What unique economic moats do professional teams or the sports franchises possess that might explain their strong performance relative to other industries?
Yeah, I think there are a few, but the biggest might be just that live sports are an increasingly precious commodity. In this age of streaming TV, live sports is one of the few areas that really requires watching it live, whether that's on TV or in person. And in 2024, for example, 75 out of the 100 most watched telecasts were sports. And sports viewership is only expected to increase, with a report from Goldman Sachs estimating that US streaming live sports viewership will increase 50% from 2022 to 2027. So that makes sports teams increasingly stand out and increasingly valuable. And second, and relatedly, sports teams often have long-term media rights deals that give them steady and predictable income, regardless of whatever else is happening in the economy. And that's an uncommon degree of certainty available to sports teams and not other businesses. Plus, if a team owns its stadium or arena, they can earn money from other events like concerts. And those have become big business in recent years, with some tours from top artists racking up hundreds of millions of dollars or more.
Yeah, and for investors considering sports team stocks, and there are a few out there, how should they think about the relationship between, if there is even one, the on-field, on-court performance and the financial performance? Is there a measurable correlation between championships and share returns, or really does it just doesn't matter, and you're just getting sports teams just going to be valuable?
Yeah, there's not been a lot of research on this subject recently. At least there's some research from the early 2000s that does suggest a link between big game performance and market reaction for English soccer teams. But I'm not sure that would still be the case today and be a trend across all leagues. But I think it is interesting because part of being publicly traded is a fiduciary responsibility to your investor to maximize profits. So I think you can think that would incentivize focusing on long run performance. So in that case, on field or on court performance should really go hand in hand with financial performance. Of course, it's not going to be a perfect correlation, right? But if your team is doing well, that means you can oftentimes charge higher ticket prices. So that means higher ticket revenue. And at the same time, a lot of leagues have salary caps that limit the maximum teams can spend to a degree. So there's no theoretical limit on revenue, but there is a limit on spending.
And the wins versus financial performance it doesn't seem to matter with the Cowboys. And I got to do that dig because I am an Eagles fan. So I have to always take my shot at an NFC East rival. But switching leagues, NBA, for example, they just recently had a media rights deal that represents a 2.5 multiple increase over the previous contract. I know sports are super popular, but how sustainable is this growth trajectory for sports and media rights? And what might be the ceiling?
Yeah, I think it's going to take a while to find out since that's an 11-year deal for the NBA. But of course, doubling or tripling the value indefinitely isn't sustainable, especially for well-established sports leagues like the NBA. But I think there's a good chance that the next deal can be bigger, especially if leagues are able to grow their global footprint, which I think has been an increasing goal for especially more US based leagues. And then also these sports teams, they have room to grow with the rise of sports betting. So that's in Goldman report I referenced earlier, estimated that US online sports betting market, it's going to essentially triple from 2022 to 2027. So partnerships there are another revenue stream too.
Yeah, and online betting is everywhere with those companies and people's mobile phones. It's just such a commonplace activity at this point. You note that sports teams are recession-proof to some extent. Could you elaborate for our listeners on how they performed during previous economic downturns compared to traditional market sectors?
So that refers to what I mentioned earlier with the long-term media rights deals. And since NBA, for example, signed an 11-year deal, if there's a recession in the next 11 years, the teams will still get a fixed media rights revenue during the recession. So that helps insulate at least a portion of the business from recession. Plus, some leagues have revenue sharing, which can help boost the bottom line for maybe lower performing teams. But a lot of these teams went public relatively recently. So we only have the COVID recession as a point of comparison, which of course disproportionately impacted live events. So it's not really representative of the performance there.
It went from full to absolute zero because you couldn't have anyone, whereas maybe a traditional economic downtown, maybe you're not selling out the arenas, but you're still getting maybe 85% capacity or something like that. And that makes total sense too, what you're saying, as far as they have this 11-year contract, for example, for the NBA. 5 years from now, if there's an economic downturn, they're still getting paid, and that the media rights are a huge portion of their income stream as well.
Yeah,
And
exactly.
the article you wrote mentions that public listings could help teams fund new facilities with less reliance on taxpayer money. That's always a hot ticket issue. Areas are struggling. All of a sudden, professional sports team wants $2 billion to build a stadium. How might this shift the economics of stadium development and potentially change the relationship between teams and their host cities?
Yeah, I think you could say it's kind of fairer way to fund stadiums, right? In the old model, cities, they often would help fund stadium development. So all taxpayers helped fund the stadium, whether or not they were a fan or an investor. But with public listings, fans and investors are opting into owning the team, knowing that might require funding a stadium. But at the same time, that new stadium might allow again for higher ticket revenue, more ad sales, things like that, which the investors could then benefit from later on.
Yeah, it's like a R&D investment in a way for these stadiums. And of course, many sports investors are also passionate fans as well. And does this dynamic create, I guess, what opportunities and challenges for publicly traded teams in terms of shareholder relations and corporate governance? It's hard to imagine anyone like getting excited over like a utility company. However, like if you're investing in an NBA team or something that's public, like you could be a diehard fan as well and think you're the GM all of a sudden.
Yeah, I think in terms of opportunities, it does provide another channel of engagement from fans, maybe an impassioned speech on an investor call, I'm not sure. And it's another way for teams to communicate to fans. So long-term strategy can be spelled out in annual reports in a way that's uncommon for sports teams and certainly not required from not privately owned sports teams. But then, of course, I think the flip side of that could be those disclosures potentially be viewed as a challenge for some teams. So, I think there's going to be pros and cons, and the teams, of course, would just have to weigh those for themselves.
And we touched on this in the beginning, whether or not more teams will follow this route. Obviously, NFL, except for the Green Bay Packers, which were grandfathered in, they're just not allowed to do it at this point. But looking ahead, do you see a future where a majority of major professional sports franchises would be publicly traded? And if so, or what catalyst might accelerate this transition?
I think there's a chance we see more sports franchises publicly traded, but probably not the majority. Though, of course, they're welcome to list on NASDAQ and prove me wrong if they
Right.
wish. One of the main catalysts, I think, simply, and you touched on this before, is the rising valuation of teams. There are so few individuals or even groups of investors that can afford the price tag of teams these days. For example, the LA Lakers, they just sold at a $10 billion valuation. And that really leaves a select group of buyers. So turning to public markets, however, really alleviates that concern. Instead of a few billionaires as the pool of buyers, you've got a few billion investors. And other factors could be maybe a big capex cycle that requires an injection of cash, especially if, like we touched on earlier as well, cities are less willing to fund stadiums, or if private valuations are at a discount to public valuations. So some maybe more cyclical factors there too.
Got it. No, that makes sense. And Michael, this has been great. I actually really enjoyed this. I love this topic. Any final thoughts you want to leave our listeners with?
I think one thing to point out is maybe some of our listeners, they might already be minority owners on sports teams, since many of the teams that are public are included in major indexes. For example, the Braves and F1, they're in the NASDAQ composite. The Knicks and Rangers are in the S&P 600. The UFC and WWE are in the S&P 500. So, next time maybe you need a fun fact about yourself or some icebreakers or something. You can tell people you own multiple sports teams.
Yes. Now, this is great, Michael. And until next time, for our listeners, you can find more from Michael NASDAQ on our website under education. You can see past podcasts that were aired and also webinars. And also you can go to NASDAQ.com and find a ton of articles by Michael and his team on the economy and everything else underneath it. Thanks again, Michael.
Yep, thanks.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry, or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances and, as necessary, seek professional advice.